many of you were hoarding toilet paper on April 7th, 2020? And I get a raise of hands. Okay, good.
I never understood that, by the way, the toilet paper thing. I really didn't understand
behavior. That's when you knew that this structurally behavior habit was so unreal that things were going to change as soon as you're going to come back to life. Now, we had the most titanic destruction of economic data in history because we stopped living.
Well,
every economic cycle comes to an end at some point. Usually a shock does it. So Godzilla tariffs are problematic for business,
10 years,
yeah, so
their 10 years going up.
Yeah, it's one of these things where we're keeping an eye on. We try to teach models. It's not the most exciting thing, but if we could just get people to learn this stuff, then I always say everyone becomes my army.
Yes, you tease them and say that people need to learn to read.
Yeah, reading is a good thing. The history of human civilization has always taught us those that read have an advantage over those who don't. So then we try to teach people it, and then eventually it works. We have a lot more people now.
Welcome back, everybody. My name is Jason Thibodeau, as usual, your host, Mortgage Lounge. And I have a pretty exciting guest here with me today. What's up, Logan? Logan Mohtashami, lead housing analyst with HousingWire. We recently did an event together, and HousingWire did me a big favor saying yes to this podcast, so I do feel pretty fortunate. I understand we don't always get a yes to this type of question.
No, we have. I tell people we had over 1,900 requests to speak.
Yeah.
In 2025.
You must really like me.
so it's also I live in Irvine.
You're in Irvine,
it's easier. I've already toured to I think 19 different cities so far this year. So I'm getting used to traveling all the time.
Yeah.
So that's just part of it. We just came back from the Keller Williams event in Dallas, Texas, and now we're getting invites from all the Keller Williams branches across the country.
Wow. So there's an insatiable appetite for your message.
Yeah, it's funny. We got one from New York, and they said, we have offices in Manhattan, Long Island, and Brooklyn. Can you go to all of them? And
are you getting sick of flying now? Is that
No, I love presenting.
Yeah. So it gives you energy. It's not sucking your energy.
So the funny part is, our family's been in banking since the late 1950s. My father's still a mortgage broker.
Oh, is he really?
Yeah.
I didn't know that. Here locally?
Here locally, yeah.
Okay.
He started his company in 1987. I joined full-time in 2003.
We're in Orange County.
Yeah,
for
Orange
anyone
County.
Listening. Yeah.
And for me, it was, doing the analyst work. Oddly enough, my background being a high school basketball coach, I was a high school basketball coach at Irvine High in the 1990s. That was good. That was my job.
Both of my boys are in OGP club basketball.
Oh, good.
Yeah. They go to Anaheim, Ladera, and the Maps in Garden Grove.
Yeah. So basketball was a big, huge. I was going to teach history.
We're at 8 games a weekend, just so you know.
Oh yeah. I know that. I know those schedules could be rough. But yeah, I was going to coach high school basketball and teach history. And oddly enough, the high school basketball coach makes it easy to present. My acting background in the 1990s helps me to present in a way that
actually makes a lot of sense.
And it's easy. Sometimes I have to get up at 1:30 in the morning to do a CNBC interview. And they always tell me, like,
are they really shooting that early?
Yeah, well, they start at 5. Over there, so I got to get up at 1:30
so
get
3
ready,
hours ahead.
and then, so it starts at 2:10. So, and they always go. You're always like,
Well, you always got a smile on your face. You're kind of like this marathon man. I'm just trying to put myself in your shoes, knowing how much travel have you done so far this year? How many trips?
19.
19, and you have how many left?
31.
31. It's almost like you're a part of an NBA team or something like that. All the travel,
like a speaking tour. Yeah. We call it the nerd tour. That's what it is.
Yeah,
it's
exactly.
The nerd tour. And,
well, we had you speak at our event. It was a forecasting event that you did a great job for us in Huntington Beach, and I knew I needed to have you in for the podcast, so I really appreciate it. It's interesting. We were talking before we got on camera a little bit about your kind of your origin story, because you were doing what I'm doing right now. You were a lender, a loan officer before.
Yeah, I was an LO for 17 years. I started writing about housing economic. It was
Like, how did you become an analyst,
This was
though?
all a tragic mistake.
Yeah, well, you were obviously educated, right? So maybe that had something to do with it.
This was never the intention. In 2010, a guy named Jason Resnick, who ran a company called Benzinga Financial.
Broker shop or correspondent?
No. It was a media.
Oh.
It was a financial media
Okay.
webpage, a brand new one. He saw me talking to one of the CNBC anchors on Facebook and said, "Do you want to write about economics for us?" And I was like, "Okay, I could write about real estate." And then it was just haphazard. I said I did things differently, more on a commentary stage. But by 2015, I said, "Oh my God, it is so bad out there." Because of yellow journalism and YouTube and Twitter and everything, doom porn sells.
What'd you call it? Yellow journalism?
Yeah, yellow journalism. It just, if it bleeds, it leads.
Okay, interesting.
So that's,
I've never heard it put that way
yeah,
before.
so you to obtain viewership and views, you have to give.
Yeah, it's clickbait.
Yeah, clickbait.
Right.
So then I thought to myself, this is wrong. So because of the doomers out there, I said, I'm going to do this in a more analytical way and bring forecasts and models and everything and just try to tell the truth as much as possible. And it wasn't for any financial benefit. My blog was free. There was no advertising. There was nothing. I just thought that had to be the right thing to do. And then at the end of 2019, HousingWire wanted me to write. At first I said, no, I miss it.
Okay, so HousingWire found you at the point where you'd been putting your work out there for
a decade.
Yeah, interesting.
So then they said, can you write for us? And it was a very small, just maybe 2 articles a month. And I said, okay, because there was a lot of mortgage people that wanted to.
This was in 2019, right before COVID.
Right before. Yeah. So here it is. And for those who aren't familiar with my work, I always said in the last decade, housing would have its weakest recovery ever. But by years 2020 to 2024, our demographics will actually be good.
Because of the millennial generation?
Millennials ages 28 to 35 are the biggest in American history. And, people buy homes a little bit later in life. So by that time, our household formations will rise, balance sheets will be better, home sales. Right before COVID hit, existing home sales broke out to pre-cycle highs.
Oh, really?
Yeah, on that February. It's funny, I track all economic data. And the month before COVID hit us, everything was up. Home sales were up, new home sales were up.
I'm trying to remember what interest rates were doing at that time.
Mortgage rates were heading lower because the 10-year yield never got above 2%.
Yeah.
We were heading
which is still very low.
It was still very low, but we were in the threes then. But housing broke out, and then COVID hit, and then everything changed after COVID because.
Right, this was a pivotal moment for you.
Yeah,
because of your forecast at that time.
And I always joke when I do the nerd tour. I said, "How many of you were hoarding toilet paper on April 7th, 2020?" And I get a raise of hands. Okay, good.
I never understood that, by the way, the toilet paper thing. I really didn't understand
behavior.
it.
That's when you knew that this structurally behavior habit was so unreal that things were going to change as soon as you're going to come back to life. Now, we had the most titanic destruction of economic data in history because we stopped living.
Well, we shut everything down.
We shut everything down. But around the world, everything. So everyone went into depression mode. And on April 7th, 2020, I wrote a COVID-19 recovery model. I gave people things to track, gave them dates to watch, and said, we're recovering this year. Housing will recover in a few weeks.
Yeah.
Nobody believed it. HousingWire wasn't even going to publish it.
They didn't want to put it out.
They want to, because it's crazy back then. They were
and
like,
did they put it out, though?
They
obviously.
put it out,
yeah.
And from that point on, we kept everybody, in track to what was going on with the data, and nobody believed it. For months and months and months. People would just go, but all the forward-looking data that we track were getting much better. And that started, the whole, nerd tour. People started taking the work seriously. I started to go on TV. And the work has become more prolific because it's become sharper. HousingWire acquired Altos Research.
Yeah, right. Is that where you originally got your data from? Like, where did the data come from?
I had my own data lines, but I loved Mike's stuff. And when HousingWire acquired Altos Research, I was like, oh my God, I'm in Christmas.
You're in heaven, yeah.
I'm in Christmas. I literally, that weekend, when they gave me access to all the data lines, I didn't go to sleep. I was like Neo from the Matrix. I just sat there and just like working and just worked every single model I could in the past, because that forward-looking data is fresh and new. And so it was. Then we just made the data more prolific, and we started the tracker.
Yeah.
That we do every single weekend.
Yeah. This is what's so unique about what you guys do. And you said forward-looking data, whereas if you're paying attention to mainstream media.
It's all lagging.
It's all lagging,
yeah.
Right?
Existing home sales are lagging. Case-Shiller's lagging. So
right.
What we do is we look at the freshest weekly data, active inventory, price cut percentages, new listings data. We tag it to the 10-year yield, mortgage rates, purchase application data. We want to be current and forward-looking always, because by the time our data hits the national media stage, we're already 2 to 3 months ahead of everyone else. So I would say it's an unfair advantage. So then we presented the tracker in a way to kind of explain to people. And then 2022 happened. Mortgage rates went from 3 to 7%.
When did the tracker come out?
At the end of 2022.
Okay.
So here it is. I was trying to get it out early. They legally couldn't do it until they got the deal done. But I
with
just
Altos.
With Altos. So I was just like, let me do it. And then finally, you were
unleashed.
I actually went ahead and started it without them knowing. And I was like, I can't wait any longer. So what happened in 2022, there was a COVID-19 recovery model on April 7th, 2020. But then there was what are called November 9th. November 9th, 2022.
That was kind of when what was hitting the fan too.
It was, and a lot of people went into the 20 to 30% home price crash. Home prices are never going to come back to the all-time highs with it. And then
rates were going up. People were freaking out.
This
is right before SVB.
Yeah, this is right before. But the forward-looking data in housing started to get better on November 9th, and we started to track
in 22.
In 2022, yeah. So rates went down. The 10-year yield started to go down. The forward-looking data, and we created a model saying when existing home sales get down to 4 million, it should stop going down, and then we're just working off the supply and demand.
Is that kind of our floor as a country then?
It's been a big part of my work for a long time, but after 1996, it's just really rare to really go below 4
From
million.
a demographics and population standpoint.
Since most sellers are home buyers, there's just to even get down to 4 million now with our population and households, that's like the biggest crash in home sales ever.
Yeah.
But it happened, it stopped, and we were kind of laughing because everybody kept on saying home prices were going to fall 15, 20%. They just make up numbers. People just...
Can you compare this to 2008? Like the low of 2008 for home sales
was about 3.8 million.
Okay.
There was a home buyer tax credit which distorted a lot of data.
I remember that.
Yeah.
Oh yeah. Tax credit, refundable, by the way.
Yeah.
I remember those.
So we had a big shoot up in demand for just before the tax credit expired, and then it just collapsed right down.
So 3.8 was the floor.
3.8 was the floor. But what was interesting in 2008, inventory actually total active inventory peaked in 2007. We got to 4 million. This is the NAR data. And then active inventory started to fall down. Monthly supply started to pick up. So much of the supply that was coming in from 2008 to 2011 were distressed sales.
Yes,
and then that became a bigger portion of the sales data, which drew prices down. Housing credit was actually breaking in 2005, 6, 7.
I remember.
8. Yeah,
and things were tightening up.
So, like this period was the exact opposite of what that was.
We have Dodd-Frank now.
Dodd-Frank, but qualified mortgage and foreclosures and bankruptcies have been falling for years, and active inventory has been falling. So I think that's the main difference. After qualified mortgage, the whole inventory channels in America have changed.
Yeah.
And
the builders' approach to building has changed too.
But even with the builders, majority of inventory always comes from the
resale.
Existing home sales market. The builders, even in 2008, their completed units of sale never got to 200,000.
Yeah, I think a lot of people don't realize that.
Yeah, they think that millions of homes come from the builders. No, I mean even
on a percentage basis, though, what is new build versus resale?
Just to give you guys an example, we categorize them as completed units of sale ready to go. These are homes that are available and do not have a contract.
Got it.
In 2007, the active inventory was 4 million. The builders, even back then, never got to 200,000. 200,000 was the peak going 5 decades. So it's not a lot of homes.
No, it really isn't.
You took
out of 4 million.
Out of 4 million active inventory,
Right.
but out of 145 million total units,
it's not a lot.
tiny percentage, because the builders don't like put their heads down and build homes.
No, they build based upon demand.
Based on their contract. They
Yeah.
take a contract. I mean, spec building is different, but they usually take a contract. The buyer says, okay, this is how I want the house built. And then 12, 16 months later, the house gets built and they go in. So there's not a lot of active inventory available for sale. So around 120,000 is usually the peak, going back to the 1960s. In 2008, it got up to 200, but that was it.
And what are we at now?
We're at 120,000, right?
Okay.
So it's...
now, there's concentrated areas, like people, if you're a doomer, you're pointing at Austin, Texas, right? You're pointing at certain areas in Florida, maybe now the southeast or something like that. Even the southwest, it sounds like. But like...
We're talking about places that are just back to 2019 inventory levels. 2019 inventory levels was the 5-decade low before COVID.
Okay,
interesting. So I when I do these charts, I always draw these black
Perspective
lines
is everything,
to see,
yeah.
Just to try to teach people. But again, if you're trying to teach people economics very boring.
Mm-hmm.
It's not this fun, sexy thing that people want to learn. We're in an industry that is very sales oriented, so actually trying to teach, the data.
And going back to your comment about clickbait,
Yeah, so it's that. So my job is to try to make it fun, entertaining, and understandable.
Yeah.
And we believe that the Nerd Tour and everything we've done, our podcast and everything, has made economics fun enough, but easy enough to understand. And, the feedback we always get is that I get it now. And real estate agents and loan officers, when they see our data, or, when they take our slides from our presentations, they show their clients and they go, wow, I didn't know that. See, in my world, I think everybody should know this data.
Yeah.
Every city I go to, nobody's ever seen this.
Yeah, it's interesting.
So it's like, for me, repetition, talking about the same things, because these are the things that matter.
Do you think you're starting to move the needle a little bit collectively?
Oh, absolutely.
Good.
I mean, you don't get to be a top 10 business news podcast if you don't move the needle, because there's so.
And you're probably ruffling some feathers too.
Oh yeah. The thing is, the different thing with me is. My personality is a little bit different than the other economists.
Yeah.
The other economists will just do the job.
Yeah.
Very stale.
Yeah.
Present the economic. I'm like Genghis Khan out there.
I see you on X or Twitter.
I'm challenging people.
It's pretty hilarious.
I'm challenging people, because I say that if you're a man in America, you show me your forecast and show me your models.
Yeah.
And what happens is 99.9% of people don't really forecast with a model, so they talk about 2008, home price crash and everything. You trap them into a debate where they actually have to show their forecast.
Yeah.
And they're wrong most of the time. So the trick not the trick, but what I learned in 2022 is like, how do I defeat the boomers? You've got to go into the devil's den and actually, in front of the devil, destroy them. So then everybody goes, whoa.
Oh, shoot.
So they have taken the bait for many years, and now they've realized what I'm trying to do.
Yeah.
So I don't get
challenged very often.
I don't get challenged.
Other than name called.
But in general, not a lot of people talk to me anymore, because they realize what I do. I just want their name and face and forecast. And we always say that you never listen to anybody unless they have at least 5 years of forecasting and you back test their models.
Now, that being said, and this is not a pushback at all, because I'm 100% with you. I think we're just kind of more returning to maybe pre-COVID levels. But like here in Huntington Beach, I know it well because I live here, right? And for a long time, maybe 150 homes, 100 homes, at its lowest point in active inventory, now we're at about 300, which is a pretty significant change from what we're used to experiencing in the last few years. And I think ultimately, correct me if I'm wrong on this, I wanted your take. Like, do you think it's an affordability issue at this point? Because once we are at 7+% on a 30-year fixed, and we have this duration, like, we're in the 4th calendar year of elevated interest rates, 22, 23, 24, 25. And it's like, it's not getting better. 10-year just hit 4.6% today, I assume, at some point, something's got to give, and that's why we're getting to the point where we're finally seeing meaningful inventory rising. I don't know, though. I wanted your take on that.
So we were part of what we call team higher rates in 2021 because
we wanted more inventory.
Because what happened was, and not a lot of people knew this, Inventory broke to all-time lows right when demand hit pre-cycle highs. So if you believe in supply and demand equilibrium, and we're like much bigger country now, and it was, to me, it was a very unhealthy environment. Not that home prices were going to escalate because demand was booming. It's just we had too many people chasing too few homes. And the only way you can get inventory to grow in America is rates stay high enough, long enough to let duration pick up. It was a controversial topic back in 2021, but it was February, and I said, guys,
we need higher rates.
If we don't get higher rates, we're about to have like home prices explode. And
I can tell you, man, I woke up every morning watching the 10-year drop another 10 basis points. Once it's dipped down below 1%, and then it dipped down below 75 basis points, and then it dipped down below 60 basis points. I called my business partner. I'm like, what are we going to do? Like, it was not fun. Like, everyone's like, oh, you guys did great. It's like all of our staff was crying. I had to beg my processors and my ops manager not to quit. Right? No one was happy. You couldn't hire anybody off the streets. It was really a rough time. That was an unhealthy environment.
I call it unhealthy in 2021, actually, and savagely unhealthy in 2020. So the reference I used is in March of 2022, our own Altos inventory data, we only had 240,000 single-family homes in America.
Unbelievable.
And as I always say, it's like the game Hungry Hungry Hippo in the 80s. You have too many people chasing.
Were you talking about resale?
Yes, resale.
240,000?
That was it.
And when was that again?
Nation, in March of 2022. We had 80.
Really? Yeah. It was that low?
It was that low. So here I am in February. In February, I coined the phrase, now we're in the savagely unhealthy housing market, because I think 87% of all the homes in America had multiple bids. And we're not talking like 3 or 4 or 5. We're talking 20, 30, with 40. So here it is, a country of 342 million, 162 million people working. Mortgage rates were at 3% or under.
There's no inventory.
It was the worst housing market I saw. And nobody understood it because they think, oh, demand is great. I said, we are basically killing future demand because home prices are... So
that's what we're experiencing these last 4 years.
Yeah, so home prices would have been up 18, 20% in 2022 if rates hadn't gone up. So we ended up only up 6%, but that's how bad it was. So now, because we're not going to get mortgage rates down to 3% anytime soon, you need inventory to grow. You need price growth to cool down. Every year, wages grow. Every year, household formations. You're working from 4 million... And there was one time in history where this housing market reminds me of, it was the 1980s. Affordability was worse in the 1980s. Mortgage rates got up to 18%. Home prices actually rose faster from 1977 to 1979 than 2020 to 2022.
During the inflation spike.
Yeah, so not a lot of people know that. But then what happened is home sales crashed. We had 2 recessions in the early 1980s. Everybody said nobody's going to buy a house at affordability. Rates went down. 4 years went by when sales didn't go anywhere, and then as soon as rates fell, demand picked up. Today, purchase application data came out.
Yeah, I'm curious.
For the first time in many years, we've had 16 straight weeks of positive year-over-year growth for the nation. And
what do you attribute that to?
It's just a very, very low bar. And last year at this time, the 10-year yield had gone up. Mortgage rates went from 6.63 to 7.5. This year, mortgage rates actually peaked in January 14th, and then the 10-year yield went down.
3.9.
And when you have years and years of record low levels of sales, eventually what happens? Wages grow, household formations, inventory grows, new listings data. 70 to 80% of sellers or buyers. Time heals everything. Price growth is slowing down. You get a little bit more demand. That's all that's happening this year. But it's the first year in many years that we've had the first positive purchase application data streak. The last 3 weeks have had double-digit year-over-year growth.
How are you feeling about your home price appreciation forecast for this year?
I might be a little too low. Last year I was a little bit too low. Last year I had forecasted 2.33%.
Wasn't it like 5% or something like that?
It ended up around 4%. Okay. And what had happened is I thought I was going to be right, but then rates fell towards 6% in the second half of the year.
That was so nice for the couple months you had it.
And then demand picked up, and then the supply and demand equilibrium firmed up pricing. This year, again, I'm even lower than last year. We're kind of right there.
Lower meaning, like, what's your forecast right now?
Mine was 1.77%. Okay. So I've back-to-back real home prices being negative. Real home prices meaning adjusting to inflation. home prices would be negative. So nominal.
So adjusted for inflation, just to be clear,
yeah,
it would be negative.
It would be negative, just like last year. So here it's looking a little bit better. I might be a little bit too low, but all this to me is healthy.
Although if inventory continues its climb.
I am such a pro supply person.
Me too.
The higher the inventory, the lower the price growth, the more affordability. Because when rates do fall, then we have a better backdrop.
Yeah.
Back in 2023, inventory was still too low. New listings data was trending at the lowest.
23 was our worst year ever.
Yeah, 2023 was bad in the sense that sales were low, price growth was almost 6% with record low levels of sales.
Yeah, and you had the SVP thing.
And it was just one of those things. The spreads got really bad.
Right.
The Silicon Valley banking crisis.
Didn't the spread get up to like 3% at one point?
3.10% because the spreads were getting better in 2023, and then the Silicon Valley screwed everything up, and we wouldn't have.
Okay, can I just ask you, since I have you here, we were talking about the spread today. It's like, what, 250 basis points right now, roughly?
It's actually, I mean, how we track it is 230 around there.
Oh, it's only 230.
It really, spreads really depends on who you quote on mortgage rates. So we follow the weekly spreads tied to Freddie Mac. So the spreads have gotten so much better from 2023 levels. If they didn't improve, mortgage rates would be near 8%. Yeah. So we're halfway back to normal. If we're normal, mortgage rates would be near 6%. Just getting normal spreads, you could get a couple 100,000 more.
Now, is normal ever going to return, though? Is this the new normal?
Normal always returns.
Reversion to the mean?
Just every single cycle post 1970, we track the spreads. There are times where the spreads were 6% in the 1980s.
Oh, geez.
Yeah.
So in layman's terms, what's keeping the spread elevated right now?
Right now, when the spreads get bad, investors need to be compensated for risk. So the spreads get better when the 10-year yield goes up now. That's traditionally what happens when the spreads actually start to compress lower. So when volatility compresses and the Fed is in the rate cut cycles, the spreads get better. So we've gone from 310 all the way down to, I think the low point of this year was 2.28.
So
we're not that far off.
Yeah, from normal, 30, 40 bips.
But usually what happens is the Fed is cutting rates, volatility compresses, and the spreads improve. This was the big fight in 2024. A lot of people thought the spreads would get worse as you get into a recession. Not all recessions, the spreads get bad. So in 2024, spreads improved. That's the only reason we got near 6% mortgage rates. And then in 2025, spreads improved again. And then the market volatility with the trade war, Godzilla tariffs, that screwed the spreads up. That cost us about 20 to 25 basis points of rates. But now they've gotten better again. So
have they come back down after the tariff scare?
Yeah, they have. Yeah.
Oh. And do you think the Fed is keeping, not that they completely control this, but maybe they do a little bit with their forward guidance and language. Do you think they're purposely wanting elevated rates at 7%? Do you think they want that?
I don't think...
Do you think they pay attention at all to like the regular citizen who's trying to buy their first home or family or anything like that?
The Federal Reserve does not make policy around the existing home sales market. That's the thing.
They're not thinking about it at all.
I mean, to them is they want to stay modestly restrictive. The growth rate of inflation is here. They want the Fed funds here. 65 to 75% of where the 10-year yield and 30-year mortgage rate goes is Fed policy.
Do you think we're overly restrictive right now?
We're modestly restrictive just on the housing stuff because this is the first time where we're having an expansion without housing permits growing.
Yeah, right.
It's very rare.
Right.
So the Fed is more restrictive to the one sector that it impacts the most.
Lucky realtors and loan officers.
I mean, if it wasn't for the builders that weren't paying down rates, housing construction would even be lower. You'd actually lose more jobs in the construction side. So that's kind
of the tipping point of a recession potentially.
Usually what happens is every single recession, residential construction workers tend to lose their jobs first.
Are you seeing any tipping point on that?
Last month was the first month that we saw a month-to-month decline with the builders' confidence falling on all.
With this duration at 7% on a mortgage, like at some point something's got to give, or no?
This cycle is so unique because so many consumers had really good balance sheets and mortgage rates. Yeah. So the 10-year yield going up and the Fed funds rate going
doesn't
up
impact
them at all.
Yeah, I get that, but at some point with enough duration, enough people want to buy. Right? or enough people who have that 2.5% 30-year fixed in a starter condo, pop out 2 kids, or need to move, or like, you know what I mean?
And they have been moving every week, every month. We see the coupon data, and people sell their low mortgage rates. Now it's not.
Is that turnover going up, or is it still pretty low?
It's always been rising a little bit, but it's just people stay in their homes longer and longer these days. So it's not like from 1985 to 2007, housing tenure was 5 to 7 years. From 2008 to 2025, it's 11 to 13 years. In some parts of the country, it's 15 to 18 years. I've lived in my home for 20 years.
So it's essentially doubled.
Yeah, so it's essentially doubled. In some cases, tripled. So in this case, people just don't move much anyway. But
you still have the millennium generation.
We still have
housing.
We still have near 5 million total home sales. 2023, 2024, we'll have it again in 2025. The peak in the last decade was near 6 million. So we're just missing 1 million mortgage buyers. Okay. When you think how unaffordable housing got, to only be down
1 million homes,
1 million home buyers to get to the peak of the last decade, that's telling you that the majority of the home buyer demand construct is still there. And this is why we still have millions and millions of home sales every single year, and that's traditionally been the case for decades.
Okay, so and you are thinking that inventory continuing to rise is a good thing, and we're still way below pre-COVID levels and all that, right?
Anything to create more supply.
Where are we at right now, by the way?
Right now, if you take tomorrow's, the NAR has their own data. We're going to get the existing home sales report tomorrow. We had 1.33 million.
We dipped at like 900,000 or something at the beginning of the year.
So normal, it's 2 to 2.5 million.
Right.
So we're not going to get to normal this year, but it's rising. It's a positive because now you see price growth. See, I'm never worried about home prices crashing. Like the history of home prices crashing nationally is very rare.
Yeah, people think 2008 was like a common occurrence. It just wasn't.
It's interesting. I always tell people if I take 2007 and 11 out of the equation, how many years did home prices fall?
I think one, right?
One technically, but it was 1990 was 0.7%. 1991 was 0.2% cumulative. That was it. So typically housing moves with inflation. This is why it's home prices are very sticky. 2008 was an anomaly because we had so many people foreclosing. Just to give you guys an example, 23% of the homes in America in 2010 were underwater. If we take the FHFA recent data, it's 0.3% today.
Yeah, I think the point that I would like to drive home with what he's talking about is Dodd-Frank, qualified mortgage, right? Even if you're not at 2.5%, you're at 3.5%, 4% on a 30-year fixed with a fixed mortgage expense, right?
But even at that, the nested equity portions are the highest in history. Like in 2008, the loan-to-value balances with people with mortgages were about 85%. Right. Today, they're at 47%.
Yeah, it's unbelievable.
40% of homes don't even have a mortgage.
Yeah.
So like over 80% of the country have over 30% nested equity on top of their mortgage. Right. Where back then we had a quarter of the homes underwater.
Yeah.
So you cannot have two more different cycles in not just housing but in economic history than what you saw from the run up in 2002 to 2005 to what we were seeing. Where we never saw like a credit boom or a cash out boom, or we had years of distressed sellers into the marketplace before the recession happened. Completely opposite, and that's why housing, at least prices, held up, or inventory is still below normal.
So if we see, I don't know if you have an opinion on what interest rates do with all the uncertainty. It's just weird because we're at 2.3% on headline PCE.
Inflation doesn't run this show.
It's the jobs,
it's
right?
the Labor Day. So this is I think the confusing part for a lot of people. A lot of people were told.
I think we're all confused though, because it's like if you told me in 2025 we'd be in the low 2% handle on PCE and interest rates would still be 7%.
Yeah.
And I get it. It's the job picture.
It's because Fed policy is the biggest driver for mortgage rates and the 10-year yield in terms of where it could range. A lot of people have thought that, well, if the growth rate of inflation falls, then mortgage rates should fall. Well, if we were at zero interest rate policy, you'd have a long way to go down with rates. However, where the Fed funds rate is right now, it actually looks perfectly normal where the 10-year yield is ranging. So,
got it.
That's how economic cycles have worked with the Fed. So my forecast.
So Fed policy is different from jobs, though. So you're saying if the Fed policy shifts, it should.
I mean, over time, let's say the Fed cuts 1% more, you can get down to 6 and under 6 easier. But to me, it's like
Do you think the mortgage spreads improve as well with that?
Mortgage spreads improve with that. But for me, it's like the only way you get rates down to 6% or below is that the labor market's breaking.
Yeah.
So there's been a few times where the bond market thinks the labor market's breaking, but it never did. So it takes rates down and then it just shoots right back up.
Yeah, that's the confusing part, right?
Yeah.
It happened late last year as well, where we got down to 3.6, and we thought finally we're there.
It's one of the things that at key levels in the last few years, I go, guys, unless we get a recession, bond yields are going to go right back up again.
Interesting, but the only thing that changes Fed policy is the labor market breaks, right?
If the labor market breaks, bond yields go ahead of the Fed.
Because one doesn't come without the other.
Yeah. So that's why in 2022 I coined the phrase labor over inflation.
Yeah.
And a lot of people just thought rates are going to go down. Inflation was going down. In fact, in 2023, the growth rate of inflation fell much faster than what the Fed forecast. Yeah. And rates went up.
But do you buy this idea with lower oil now, drill baby drill, and then if I'm assuming a 4.5+ year 10-year Treasury with duration at some point is going to slow down economic activity, you would think, right?
Like, well, here's
isn't that the cure to higher rates at some point? Higher rates.
The thing is that
I think like what we're all looking to hear from you is like, is there a light at the end of the tunnel here?
Here's the thing.
Or is this just purgatory forever?
The trade war has, in a sense, made everything a little bit more complicated. Yeah. The trade war, if the Godzilla tariffs stayed throughout the whole way, we're going into a recession.
Oh, for sure. Yeah. So that was all,
So everyone, the
art of the deal.
Bond market, the 10-year yield went below 4% on the Godzilla tariffs because the stocks were selling off. But even me back then was like, guys, if there was no Godzilla tariffs, the 10-year yield should be 4.35 and 4.35 to 4.7. Yeah. So the labor data is not breaking. We have triggers for labor cycles that we track. I would say
back to the construction piece.
Yeah, back to the construction, but all economic cycles. So we try to find ways where we could actually spot the breaking. And so far, we haven't had any breaking data yet. And what the trade war has done is that the Federal Reserve has now raised its inflation expectation, which means that these lower CPI and PCE prints don't really matter.
Because we're about to get hit. Yeah,
we're about to get hit. But then if we make some more deals, so we have to wait to see the outcome. But once the Fed raised its inflation expectations for 2025, that means that you really need the labor market to break because they are just going to be holding pat.
Watching economic data is like watching paint dry. It really.
Well, for me, it's I know.
Nothing happens quickly. We're in calendar year 4, and we're still having the same conversation. When's the labor market get a break?
That's why in 2022 I had to come up with that statement because I thought too many people were just well into the rates are going to go lower because the economy was going into recession or inflation, and I was like, it's not.
10-year Treasury though, or I'm sorry, the inflation rate. Like, do you buy if we're following mortgage guys who follow the bond market, they're always saying, "Oh, shelter's catching up finally. It's super lagging with PCE."
Inflation
and CPI.
data does not matter with where Fed policy is.
But my point is, what if we get dipped down below 2% at some point because inflation starts catching up? And we have duration on this higher 10-year, and I know labor hasn't broken, but now we're getting headline numbers of 1.6.
You can get the Fed to do their 2 rate cuts, but the trade war has changed that.
Okay.
So the inflation expectation rose, and once the inflation expectation rises, this is why the bond market doesn't really act toward the growth rate of inflation. Now, if we had no trade war, then it's different. Then it's like, okay, we're going to get the 2 rate cuts, and then every time the Fed cuts rates slower, the 10-year yield has the better capacity to go down to its lower range. So everybody says, well, the tax cuts and deficits and debts, I always like to remind everybody, in the 1990s, the debt to GDP was much lower. The total debt was lower. The deficits were lower. Yeah. 10-year yield was much higher.
Yeah.
I mean, we broke to 480 which today we're at, 460.
Well, I mean, this
we
is
up to 480 in the 2001 recession.
these are normal rates, though. We don't have quantitative easing anymore, and things are just normalizing. We're just not used to it. I don't think.
So I just think as long as people can remember that most of where the 10-year yield mortgage rates is really Fed policy.
Okay.
And the growth rate of inflation falling is wonderful news. That's what you need. Real wages are up. The Fed loves to see that. But the Fed was always going to be as restrictive as possible until the labor market breaks. And now, they're still talking about getting those 2 rate cuts in, even with inflation expectation rise because they see tariffs as
Well, they want to normalize policy at some point.
They had an interesting game plan in 2022. Jerome Powell came out and said, we would like the Fed funds rate to mirror the growth rate of inflation, 12-month PCE. Which is all 2.5%, which means the Fed funds rate would be 3%.
Isn't that considered neutral anyway?
Yeah, I mean, that would be neutral policy. Then they changed, I always joke that somebody spiked the Fed's eggnog around Christmas because they changed everything. All of a sudden, they went to a super hawkish stance, and that's where I came up with the...
It has been confusing watching them, I think when the 10-year finally dipped down last year to 3.6%, it was because policy shifted, right? The baby pivot.
Well,
do you remember that?
We're
what? It's hard because they're constantly changing their tune.
The 10-year yield at 3.62 was pricing in a recession. So
it was.
As soon as
why were they so convinced that a recession was coming at
because
that time?
The growth rate of jobs, the revisions were negative, and then the Fed.
But that hasn't changed.
The Fed themselves panicked in a sense. They
had an emotional response.
Jerome Powell even said in the last press conference, we were a little bit late in cutting.
Yeah.
So they kept policy restrictive. So they're just trying to find a neutral rate. So you don't need the labor market to break to get 6% mortgage rates. We just need 1% more of rate cuts. If the labor market's softer, then the bond market will do some of the.
So that's my big takeaway here, because what I'll tell you, at least anecdotally, at our branch and our local marketplace, when interest rates hit 6.25, I don't need a 5 handle.
Yeah.
Give me 6.25, and guess what? We were cranking.
We saw the data last year and we saw it in late 2022 and early 2023 when mortgage rates range between 6 to 6.64.
Yeah.
All the forward-looking data gets better.
And I don't feel like that's inflationary. For
no,
housing.
that isn't. That isn't. The Fed, the president of the Minneapolis Fed came on TV in 2023 and said, "Oh my God, mortgage rates are 6%."
Right.
And I was like, "You idiot!"
That's why I asked earlier. Do they want
6%? Is not going to do anything. My God, So that's why I had to tell people they just want to be. They want it to sound very restrictive. But here, I think that they'll be if the trade wars, once that's all settled, and we could have the progress in inflation, they'll sound a little bit more dovish. Or the labor market eventually gets too soft.
We just want normal, Logan. We just want normal. That's all I want.
Yeah.
I just want to do normal business. I don't need 3%. I also don't want 7.5%. I think a lot of people agree with that. Last question, and then we can wrap it up. I really appreciate your time today. Is do you think the labor market breaks at some point with everything going on?
Every economic cycle, labor breaks. But
this is just a weird one, a long one.
This one, it would take me 2 hours to explain why, but...
Well, you had the COVID cash, right? You had the helicopter money. You had forbearance on mortgages. You had no payments on student loans, right? You had the auto industry was passing out loans.
I would tell you this, because all that stuff kind of ended in 2022.
It has, right.
Yeah. So what's happening right now is majority of the consumption in this data, or in America, are homeowners. And homeowners,
so people with wealth.
Homeowners on paper have never looked better.
Yeah.
Fixed debt costs, rising wages, their FICO scores are great. So the 10-year yield going up and the Fed funds rate going up doesn't necessarily impact them.
Yeah.
Like it used to.
But we feel bad for the millennials who are trying to buy.
But for mortgage buyers, but if you look at it, there's 145 million total housing unit, or 147 million total housing units, 105 million is single family.
Yeah.
The majority of stock are people already got a house. So, and they're living in their homes longer and longer. Their cash flow is so good now compared to what it is. And whatever you're seeing in FHA stress or anything like that, these are just a small sliver of the total pie.
Yeah.
So to me, it's the 2005 bankruptcy reform laws and the 2010 qualified mortgage laws set the stage for the longest economic and job expansion in history, and it's been tested so many times. and even right now in 2025. But every economic cycle comes to an end at some point. Usually a shock does it. So Godzilla tariffs are problematic for business,
10 years,
yeah, so
their tenure's going up.
Yeah, it's one of these things where we're keeping an eye on. But last jobs report, construction workers lost their job, residential. The Builders Confidence Index is only 4 points away from the COVID-19 lows. These are things that we're
getting close.
We're looking at it. And I always say that the labor market is getting softer, but it's not breaking. This is what we call a progression model, which is hideously boring. If you're
watching paint dry.
In a day of doom porn, you want to say recession, but it's just I can't go to that until I see the.
Let's close on this, and I'm going to challenge all you people who are watching, who are doom scrolling on X, okay? And every other post is housing's crashing. I'm going to challenge you because it's not healthy for our mental health, just so you know. Instead of just unconsciously going to that default in your mind, why don't you try instead? Where do they find your stuff?
Okay, so the best way, we actually have 1 million people coming to my Instagram page a month now. On Instagram, I talk about all the economic data, live stories.
I like your updates. It's great.
Stories.
You got a new editor, I can tell.
We do, yeah. It's interesting because now that we have like 1 million people come there, it's like we opened it up and we have thousands of messages. My job is just to explain everything.
Yeah, you're not responding.
I'm not. No, I'm responding.
Are you?
I'm responding. Geez. But it's we do live Q&As every Friday, so people ask questions
on Instagram.
Okay. And every single day on stories, we talk about all the economic data. So it's almost like live 24/7.
I see your stories. I constantly listen to them, especially when something happens, like with the tariffs.
So we just try to do this so everyone can get up to date. HousingWire Daily is our podcast. We have an Apple, Spotify. We have a YouTube page.
YouTube, yeah.
I
use YouTube.
We're on 3 days a week, Sarah Wheeler and I. We keep it fun.
You guys aren't sick of each other yet?
No, not
3 days a week.
Not yet. But it's a top 10 business fund. We did not mean to this to be anything big. But
it's incredible. It's nice work.
It's fun. And on HousingWire website,
the tracker, right?
The tracker comes out every single weekend, and it's just there to keep everyone versed with what's really happening with real data.
Again, that's leading data rather than lagging
leading data. It's not. We're about 2 to 3 months ahead of everybody. Not fair.
There's really no reason you should be following lagging data on this stuff, and just be careful with the doom porn.
Again, we always say doom porn sells, but my job is I try to make it as fun as possible to try to get as.
You do a great job,
and we are able to break through the doom porn things, and a lot of it is because I actually go on their YouTube pages. If you guys want to see,
I've seen the fireworks. I've seen the fireworks, at least on X. I have, and I can vouch for the fact that at the event where you spoke for us, everyone was really engaged and loved it, and so you do a good job.
So that's the old high school basketball coaching actor. Try to keep up. But again, what we just math, facts, data matter. The rest is storytelling. We try to teach models. It's not the most exciting thing, but if we could just get people to learn this stuff, then I always say everyone becomes my army.
Yes, you tease them and say that people need to learn to read.
Yeah, reading is a good thing. The history of human civilization has always taught us those that read have an advantage over those who don't. So then we try to teach people it, and then eventually it works. We have a lot more people now.
Logan Mohtashami, thank you for joining us.
My pleasure to be here.
All right, everybody, if you like what you heard today, we do always appreciate a like and subscribe to the podcast. This was a special treat today because it's hard to get somebody like Logan to show up, and super appreciate your time.
My pleasure to be here.
All right, guys. See you later.